The COVID-19 pandemic affected each business in America a different way. It is no surprise that business owners had to adopt unique strategies to weather the worst of the pandemic and also to continue as a going concern once the pandemic was officially over. During the pandemic, federal, state, and local governments enacted laws to assist businesses. In particular, the federal government, through the Coronavirus Aid, Relief, and Economic Security Act, or CARES Act for short, enacted several provisions to assist businesses financially. These provisions were mainly geared at helping businesses keep their employees on the payroll through quarantine stages of the pandemic. One of those provisions, Section 2301, provided for an employer credit called the Employee Retention Credit, or ERC for short. Currently, if you're a business owner with employees, or even without employees, you likely receive dozens of phone calls, text messages, and emails daily guaranteeing that you are leaving tens and even hundreds of thousands of dollars on the table by not taking advantage of this credit. In this video, I will provide a brief overview of the ERC as well as the changes made through amendments to the original code. There are many videos and other media available on the internet that explain the history and reasoning behind the amendments to the Employee Retention Credit, so we will not visit them in this video. However, it is important to note that the original Section 2301, the ERC section of the code, was amended 3 times, and each time the section was amended, the language essentially changed who was able to claim the credit and when they were able to claim the credit. That is, can they claim the credit retroactively, and if they were able to claim an advance based on the anticipation of receiving the credit. Now, most employers can make a fairly rapid assessment of their eligibility to claim the ERC credit. Employers can do this by first understanding 3 key terms in the code. These terms are, first, who is an eligible employer, which includes tax-exempt organizations. Second is qualified wages, whether they occur due to a full or partial shutdown by government order, or they occur based on the decline in gross receipts rule. It is important to view this information now, not only to determine if you qualify for the credit retrospectively, but also to verify if the credit was claimed correctly if it has already been claimed. Please note that the IRS, for purposes of the ERC, has extended the usual assessment period of 3 years to 5 years. That is, they can determine that an employer has incorrectly claimed the ERC or has claimed more than they were entitled to. Then the IRS has 5 years to request that the credit be paid back. The documentation retention requirement is also increased to 6 years. The third and final term you have to understand is gross receipts. The definition depends on whether the employer is classified as running a business for profit or is a tax-exempt organization. Notably, Revenue Procedure 2021-33, published on August 10 of last year, clarifies that even if a PPP loan was forgiven, for purposes of claiming the ERC, employers can choose to exclude the amounts received from gross receipts to meet the significant decline in gross receipts rule, which is 50% for tax year 2020 and 80% for tax year 2021. So let's first take a look at the actual credit amounts that can be claimed, before we take a look at how an employer might qualify for the credit. As the employer, you have a good idea of the credits, grant money, and possibly forgiven loan monies that you have benefited from. The most important thing to keep in mind when determining if one is eligible to claim the Employee Retention Credit is context. By that, I mean that we can partition who is able to claim the ERC into 4 separate categories dependent on the period that the ERC is being claimed. Within each period in which the ERC can be claimed, we have to consider the total qualified wages paid and whether a tax or credit benefit has already been received based on those qualified wages. It is the employer's responsibility to ensure that a double benefit is not claimed, with one notable exception through the work opportunity credit. So in essence, if you want a procedure for determining your eligibility for a credit, or the ERC, one suggestion is to start in the period for which you think you qualify. Next, determine if you are an eligible employer. If you are an eligible employer, then determine the amount of qualified wages still available for which you can claim a credit in that time period. And remember to keep a record of what you found. So let's take a look at how the code defines eligible employer. And then a little later, we're going to look at how the code defines qualified wages. So within the code, an eligible employer is defined as any employer carrying on a trade or business during calendar year 2020 and with respect to any calendar quarter for which one, the operation of the trade or business carried on during calendar year 2020 is fully or partially suspended due to orders from an appropriate governmental authority limiting commerce, travel, or group meetings for commercial, social, religious, or other purposes due to COVID-19. Or two, such calendar quarter is within the period in which the employer had a significant decline in gross receipts as described in Section 203C2B of the CARES Act. Qualified wages are defined as either wages as defined in Section 3121A of the Internal Revenue Code or as compensation as defined by Section 3231 of the Internal Revenue Code. Please pause the video to review these definitions on the right-hand side of the screen. In addition to how wages and compensation are defined within the relevant sections of the code, wages include amounts paid by an eligible employer to provide and maintain a group health plan as defined in Section 5000B1 of the Code, but only to the extent that the amounts are excluded from the gross income of employees by reason of Section 106A of the Code. Additionally, if an eligible employer averaged more than 100 employees during 2019, they are considered a large employer. For large eligible employers, Section 2301C3B of the CARES Act limits qualified wages that may be taken into account to the amount that the employee would have been paid for working an equivalent duration during the 30 days immediately preceding the period in which the qualified wages are paid or incurred. So if you have an employee that earned $4,000 in the 30 days prior to the qualified wages paid period, then this is the limit to the wages that can be used to claim a credit for that employee. Lastly, let us review the definition of gross receipts. So under Section 448C of the Internal Revenue Code, for businesses that are carried on for profit, gross receipts are essentially gross receipts netted against returns and allowances. And for tax-exempt organizations, under Section 6033, gross receipts are the total amounts the organization received from all sources during its annual accounting period without subtracting any costs or expenses. And on the left-hand side, we can see how the term significant decline in gross receipts is defined for tax year 2020 for purposes of claiming the employee retention credit. It is essentially defined as a decline in 50% of gross receipts from the same calendar quarter in the prior year. This ends once the employer's gross receipts are greater than 80% of gross receipts relative to the prior year quarter. As mentioned earlier, for tax year 2021, the percent for determining a significant decline in gross receipts is increased to 80%. Again, there are many rules that apply within context for your unique situation. As the law changed, so did the qualifying factors as well as the amounts that could be claimed. Please review the relevant IRS notices for the period in question for further understanding and guidance. Here is a list of items you should consider if you are receiving calls, text messages, or emails from someone promising you a large refund through the ERC. Number one is that not everyone qualifies. There's also no such thing as bigger refunds or industry secrets. It is not a quick process. You should never pay fees contingent on a refund. And a note on this not being a quick process, you need to consider that for Form 941X, the IRS requires that you paper file, and the current processing times are between 6 to 8 months. I find that if you ask these people if you still qualify for the ERC if you've never had employees, they usually hang up and never call again. Or if they're sending you text messages, they never text again. Or if they're sending you emails, they never email again. because you have to have employees in order to have qualified wages paid to them. Let's move on to how to claim the credit. You were able to claim the credit on an original employment tax return, IRS Form 941. But if you had concerns about eligibility or had other reasons not to claim a credit, you can claim a credit now by filing an adjusted employment tax return, IRS Form 941X. If you claim qualified wages as a payroll cost to reduce your business entity taxable income, don't forget you must also amend your tax return, either Form 1065 or Form 1120, etc., and pay any tax liability owed based on the increase in net income. If you still do not have a tax liability as an employer on Form 941X, then you can file a claim for a full refund of the ERC. To claim the credit, the first thing you have to do is gather information and the appropriate forms and form instructions. Open your web browser and navigate to the IRS website by typing their web address in the navigation bar. Here, you go to the Forms and Instructions tab. If you type a form number on the search bar here, it's going to give you the current forms and instructions. Okay, so that's for the current year. So you can go ahead and type Form 941X to get the form you need for the adjustment that you need to make to Form 941. You're going to also need the prior year forms to complete this adjustment. The Form 941X instructions do not include the instructions that are included on the original 941 forms. It also doesn't include the definitions that you'll need for items such as taxable Social Security wages, taxable Medicare wages, sick leave, and family leave pay. So all those terms are defined in the original instructions. What you'll want to do is go down here to the Find Prior Year Forms, Instructions, and Publications. You click on that link. Okay? So now when you type in an item like form, and I have it here actually already loaded up, so 2020 Form 941. Okay? And you click the button here to search for those forms. Let's try that again. 2020 Form 941. And I'm just going to click enter instead of clicking the button to search. So now you have here the revision date is in 2020 here. So you have Form 941, you have the instructions, you have the different schedules like for Puerto Rico, the 941 for them, the 941 SS for other U.S. possessions like American Samoa, Guam, all those places. Okay, and then look here, you have the prior year 941X. Okay, but we're actually going to use the current year 941X. For this example, I'm going to keep things very simple by focusing only on filling out the appropriate items on Form 941X. In my example, I consider an employer that was a sole proprietor with 2 employees that were not related to him. For context, I assume that the employer wants to claim the ERC based on qualified wages paid during the second quarter of 2020. And further, for purposes of this example, let us say that there were 3 complete weeks during this quarter in which qualified wages were paid, and that the employer claimed the sick leave credit on the originally filed Form 941 for 2 of the weeks. The Form 941 as originally filed should look something like this. We're assuming $30,000 in taxable Social Security wages. We're also assuming qualified sick leave wages of $5,000. And we have $35,000 in taxable Medicare wages. So recall that qualified sick leave wages have to be included in Medicare wages to determine the amount of tax. Okay, they're not excluded here as they are excluded from Social Security wages up here. We can verify the math for the actual tax amounts in column 2. But essentially what it is this decimal here, 0.124, that corresponds to the 12.4% that the employer would pay. Half of it is on the employer side, half of it is on the employee side, taxable Social Security wages. Okay, so you multiply the 30,000 by the decimal 0.124 and you get 3720. Okay, likewise, in this case here, for qualified sick leave wages, those wages that were claimed for the credit, they're only multiplied at half of this amount here. Okay, so half of the rate, because that corresponds to only the employee side of the tax. Okay, so you have 0.062, okay, which corresponds to 6.2% of the tax. So that gets added here, 310. Okay, and then down here again you have the total Medicare wages that are taxable. Is essentially the combination of these two here. Okay, and that's going to be taxed at this rate of 0.029, and that corresponds to the 2.9%. Again, half of that is 1.45% for the employer side and 1.45% on the employee side, and that applies to all wages. Okay, and the result there is 1,015. Okay, right here on line 5E, we're going to just total the amount or add the amounts in column 2, and we get 5,045. That was the original tax liability. Okay, then we go down here to total taxes. Nothing changes. We assume nothing changed on line 5F, so we have still the same amount that is owed here. Okay, again, we assume zero amounts here just for simplicity. Okay, and now we have the total taxes after adjustments is still the same, 5,045. Now, we would have to go to that form's instructions for that period, okay, to look at worksheet 1 and calculate this amount. Okay, so I do actually have the instructions here. Okay, and if we go down, scroll down all the way to here, worksheet 1. So what we have here is the worksheet 1. Zoom out a little bit. Worksheet 1, and this is included in the instructions for the originally filed 941 payroll tax form. Okay, you'll notice the first thing, the first item that they have is to determine the employer share of Social Security tax this quarter after it is reduced by any credit claimed on Form 8974. Again, that 8974 corresponds to the qualified small business payroll tax credit for increasing research activities. And this one here is Form 5884. This series is for the work opportunity credit. Okay, so again, for simplicity, we're going to assume that we didn't have any of those in our situation. Okay, so the first thing, again, you just go through the worksheet. You enter the amount of Social Security tax. Okay, so this was done when it was originally filed. Okay, so we have the 3720 that corresponds to this amount here. Okay, and then we have, if there was any adjustments, we had none. So enter the amount of Social Security tax from 5B. If you take a look at it, 5B is the taxable Social Security tips. So that's only for tip income. Whenever you have more than $20 in a single month for an employee that receives tips, if you have more than $20, those are subject to FICA tax. Okay, so that's what that is referencing there. So we're again assuming zero just for simplicity. Okay, so we add those two. Of course, we get the same amount, 3720. Okay, and then we multiply that by 50%. Okay, so half of that is 1860. Check my math if I'm wrong. Please let me know in the comments. So you go down here. If you have a third party, again, we're going to assume we don't have a third party here, so we're going to leave that at 0. Okay, and then we subtract the line. So we have 1860, and in the end, we're going to have the employer share of Social Security tax being 1860. Okay, we then would go to the total non-refundable credits. So what they mean by non-refundable credits here is that those credits have already been applied to cover the tax liability, as we're going to cover this tax liability right now. Okay, so we assume zero. So we had no other credits that were going against the tax liability. So there's no adjustment to be made here. Okay, so then of course it says total and employer share of Social Security tax remaining. That's, take the literal understanding of that. That's what remains. Okay, you still have to pay 1860 at this point. Okay, so now we're going to figure the sick and family leave credit. So we enter the amount of qualified sick leave wages, okay, that we entered here, okay, on 5A. We take that, we enter it here, 5,000, okay. Qualified sick leave wages included, but not included on 941 because the wages reported on that line were limited by the Social Security wage base. We're just going to assume zero here, okay. So I'll put a zero there a little later. So the total qualified sick leave wages, when you add those two lines here, of course, it's going to stay the same at 5,000. Okay, you follow the instructions. Qualified health plans, we're going to assume zero again. Just keep things simple. Then we have the employer share of Medicare tax on qualified sick leave wages. Okay, so you're going to multiply whatever the amount is here, okay, by 1.45%. So again, it's the employer share of it. Okay, that's what the employer would pay. So you get 72.50. Okay, and then so the credit for qualified sick leave wages is going to be 5,072.50 again. So you're recapturing the amount here that was paid on the tax for these wages. Okay, for these wages here. So that tax is in here. Okay, and you're just kind of like recouping those $72 on the employer side. Okay, so you have the credit for qualified sick leave wages is 5,072.50. Again, for these items here, the qualified family leave, wages included on form. All these we're just assuming zero amounts, okay, to keep it simple. So it's not going to change our credit here, okay. So down here we have the credit for qualified sick and family leave wages. It's still the 5,072.50, okay. And then so we take the non-refundable portion of the credit, okay, that's going to correspond to the employer share of Social Security tax remaining, okay. So you're getting the credit and you're immediately applying it to your tax liability here, okay. So you're going to subtract from 5,072.50 the 1,860 that you would owe for Social Security tax and Medicare tax, okay. And so you have remaining, so that becomes here non-refundable, okay, because you have to make that deposit. So you have your credit here, the 5,072.50, okay, and so that 5,072.50 is going to cover the tax liability that you still have remaining here for the employer share of Social Security tax, okay. So once it covers that amount, then whatever is left over, you can claim as a refund. Okay, and that's what we did, or we're assuming that we did back when this was filed, presumably in the second quarter or immediately after the second quarter of 2020. Okay, so again, here you have the non-refundable portion. It's non-refundable because it has to cover that tax that is still owed. Okay, and again, we have 5,045 in Social Security and Medicare taxes that are still owed. Up to this point, we went to worksheet 1 to calculate the non-refundable portion of the credit for qualified sick and family leave. We determined that was going to be 1,860. Okay, so then we just follow the worksheet. Okay, we continue on to the next page. So the total non-refundable credits are going to be 1,860 on the originally filed 941. The total taxes then would be whatever remains from subtracting 1,860 from 5045 up here. That amount is 3185. Okay, so the total deposits for this, I'm assuming that the employer, talked to their accountant, or maybe they just know from experience about how much they would pay for each quarter, and I'm assuming that taking into consideration the qualified wages and being risk adverse, they decided, you know what, I'm going to go ahead and pay the payroll tax that would be owed. Okay, just in case I don't get approved to receive that credit for sick leave wages. Okay, so let's assume here that we have that deposit. So let's continue down the worksheet. So we have the 5,045 still owed here, the total tax after adjustments. Okay, we have now the non-refundable portion of the credit for qualified sick and family leave wages from worksheet 1. Okay, so we're only claiming the qualified sick leave here. Okay, and we have the 1860 that we determined was non-refundable. Okay, so and that's because they pay for the employer portion of this tax here. Okay, and for this tax here, the employer portion for that. Okay, so you get 1860. That's going to go against the 5045. Okay, you have total taxes after adjustments. Okay, so you subtract 1860 from 5045, and you get 3185. Okay, now down here, I'm going to assume for the example for this example, I'm going to assume that the employer is really risk adverse, and so he was worried about not qualifying to take the credit. Okay, given that he is a Schedule C filer, but he does have employees that are not his relatives, so he wasn't sure if he was going to be able to claim it. So he decided, I'm going to go ahead and pay the 3,000, okay, that I think I'm going to owe if it doesn't get approved. Okay, so technically he should have sent the 5,000, but he got reassured that he was going to be able to claim the credit. So he says, okay, so let me do that just in case I don't get the non-refundable portion. Okay, so fortunately he does qualify for that, so he gets the refund here. Okay, so the refundable portion of the credit for qualified sick and family leave wages, okay, is at the remaining amount from our worksheet here. Okay, so we took the 5072.50 that was available as a credit, and we reduced that by 1860, the non-refundable portion, and we had 3212 with 50 cents left. Okay, so that amount is entered here, and then we add these two amounts, the 3,000 and the 3212 here with 50 cents. We add them together, and so I have a result of 6212 with 50 cents. Okay, again, for simplicity, we're assuming that, so the total advances, we're assuming that there was no advances taken. Okay, so the total deposit, deferrals, and refundable credits less advances would be the 6212.50. And then, so what we do is we still have this liability here. Okay, so we subtract this amount, the 3185, from the 6212 with 50, and we have the 3027.50 that's being sent as a refund. Okay, so you check the box here, and if you wanted to apply to the next return, so you would have checked here if you wanted that. So we're assuming is that client said, you know what, let's go ahead and get that refund. I could use the money right now. Okay, so you check the box to get the refund. Okay, so that's what we're assuming for the originally filed 941. Now let's move on to the form to make the adjustment. So let's move on to the form 941X. Okay,